Welcome to the Pro Ticker Deep Dive. For years, the investor playbook was really simple, almost comforting.
Totally. When the economy felt shaky.
Right, especially with inflation. The instinct was just to rotate straight into consumer staples.
The essentials, groceries, cleaning supplies, the things people buy no matter what.
Exactly. And for a long time, companies like Tyson Foods and Clorox, they were the definition of a defensive safe harbor, a place to ride out the storm.
But that storm has changed.
That's the thing. The whole playbook, it was built on raging, unpredictable inflation. We're talking about those chaotic double-digit swings we saw from 2021 through 2023.
A huge tailwind. It gave every company a free pass to raise prices.
And now, that's gone. Inflation is stabilizing. It's moving back towards something predictable, manageable, low single digits. So here's the core conflict we're really digging into today. Does that old defensive playbook still work when the main tailwind just disappears?
That is the crucial question. And what's fascinating is how violently the market has already started answering it. It's moved on.
It has. The focus has decisively shifted from, riding those macro waves to demanding real, demonstrable operational excellence. We're seeing a radical split.
A divergence in performance.
A huge one. Look at the last year. Tyson Foods is down, sure, but only about 3.35%. That's manageable.
Okay.
But Clorox, it has absolutely cratered. It's fallen nearly 28% from its 52-week highs.
Wow. A nearly 25-point difference.
Exactly. And that gap between two classic defensive stocks, it tells you everything. The market has already priced in that defense and is now demanding proof of internal growth, of efficient execution.
Okay, so let's unpack this. Let's figure out why the market is punishing one and, just sort of tolerating the other.
Right.
Our mission today is to use these two case studies, Tyson and Clorox, to really contrast why one company seems to be thriving through execution, while the other is just struggling with this deep skepticism about its future.
It really is the separating of the wheat from the chaff. So let's start with the macro backdrop. It wasn't that long ago, 2021 to 2023, that we were in a really unique inflationary shock.
A perfect storm.
It really was. You had stimulus, supply chains just collapsing, energy crises, a tight labor market.
And that all sent prices to a 40-year high. What was it, 9.1% in June 2022?
That's the number. And that was the environment that made these staple stocks look, well, invincible.
And the implication of inflation that fast and that chaotic was simple. Companies could just pass any cost through to the consumer.
And then some.
Oh, absolutely. Many raised prices faster than their own costs were going up. It was like automatic margin expansion, a management sweet spot. You didn't need innovation. You just needed inflation.
But that world is gone. The Fed's actions, they've worked. They've cooled things down significantly.
We're only seeing it in the numbers.
We are. The USDA is projecting food-at-home prices are only rising 2.4% in 2025. That's a huge slowdown from the 5.8% we saw in 2023.
And domestic food prices overall, just 2.7% year over year as of August.
Even globally, OECD headline inflation is holding steady at 4.1%. It's still here, but it's not chaotic anymore. It's predictable.
And that stability, that's actually the biggest threat to this sector. The profound implication is that when inflation stabilizes, that easy automatic pricing power, it just evaporates.
Consumers have had enough.
They're exhausted. They're pushing back on price hikes. And competition is back. Companies can't just hide behind inflation to cover up mediocre volume anymore.
They have to prove it.
They have to prove their worth through innovation, winning market share, or just true operational efficiency. The honeymoon is definitively over. Execution is now king.
Execution is king. Okay, that brings us right to our case studies. Let's start with Tyson Foods, because their strength isn't about inflation at all, is it? It's about a structural supply issue.
That's right. It's about supply tightness that they are perfectly positioned to capitalize on.
So what's the key mechanism here?
It starts with cattle. The supply has been tight for a while. The USDA is only forecasting a very modest 3% increase in domestic beef production in fiscal 2026.
And when beef gets scarce and expensive,
consumers shift. They move to chicken. And Tyson is right there to capture that entire trade-down effect.
And that's driving profitability.
Phenomenal profitability. Their chicken segment is guiding for a massive $1.25 to $1.5 billion in adjusted operating income for 2026. That's extraordinary for what's usually a commodity business.
But it's not just luck, right? They're doing something internally.
Oh, absolutely. This is about execution. Look at their fiscal 2025 results. Sales were up a modest 3.3%. But their adjusted operating income, it jumped a staggering 26%.
26%.
That gap, that's the definition of operating leverage kicking in. A small increase in sales leading to a huge jump in profit.
Can you just unpack that term, operating leverage, a bit more? Why is that so critical now?
Sure. It just means you're getting more profit out of every dollar of sales because your fixed costs, your factories, your trucks are spread over more volume. When inflation was hot, they just hiked prices. Now they're focused on being efficient.
And we see proof of that.
We do. In the data. Fresh chicken sales jumped 7.8%. Branded frozen chicken was up 8.7%. But here's the detail that really stands out to me.
Okay.
Their prepared foods segment. Their fill rates hit the highest level since 2013.
Fill rates. That sounds super technical. Why should an investor care about that?
Because fill rates are the bedrock of a reliable supply chain. It means when a retailer like Walmart orders something, Tyson delivers almost all of it, on time and in full.
Fewer screw-ups.
Exactly. Less wasted transportation, lower admin costs, and, critically, happier customers. In this kind of environment, that boring, elite execution is how you win.
That makes perfect sense. So they're winning because of internal discipline plus a favorable external dynamic.
Correct.
Okay, now let's pivot to Clorox. This is a tougher story.
Very different narrative, yes.
For Clorox management, they spent the last few years prioritizing gross margin expansion.
Mm-hmm.
And to be fair, they were crushed by input costs.
They were. And they were incredibly disciplined in their response. They achieved 9 consecutive quarters of gross margin improvement through Q2 2025.
9 straight quarters.
An impressive, sustained level of discipline. It shows they know how to manage costs and pricing.
So if they've done that, why is the market just ignoring it? Why is the stock down almost 40% from its highs?
That is the core question. And the answer, unfortunately, is that the market is just fundamentally skeptical about their growth.
Their organic growth.
Precisely. Can they actually grow by selling more volume, winning new customers, not just by tweaking prices and mix? Margin improvement is great, but volume growth proves your brands are still relevant.
Right.
Now, it still has some appeal. The 4.73% dividend yield is robust, and that 40-year dividend growth streak is a fortress.
But there's a yellow flag.
A bright one. Management has signaled they need to ramp up advertising spend in the second half of 2025, and that tells you they know brand momentum has slowed way down. It needs an expensive push.
Okay, so we've got the operational dynamics. Let's see if the numbers, the technicals, and the valuations back this all up. Let's start with the bull case for Tyson.
The central argument is still the inelastic demand for protein. People have to eat.
Right, and the bull case rests on them capturing those beef supply constraints, plus that great operating leverage we talked about across brands like Jimmy Dean and Hillshire Farm.
And critically, the valuation gives you a cushion.
How so?
Tyson's trading at a forward PE of roughly 14x. That is significantly cheaper than the broader market.
And you have the dividend.
A 3.73% yield, which they just bumped up by 2%. It gives investors a decent buffer while they wait for the story to be recognized.
What are the big risks, though? Relying on cattle supplies sounds a little fragile.
It's a key risk, for sure. You have to monitor it, and there are always internal risks. Food safety, labor disputes, a spike in grain costs, and the beef segment is a headwind. They expect an operating loss there.
So the chicken segment has to carry the weight.
It does.
No.
But right now, it's more than offsetting the beef weakness. The question is for how long.
And what does the stock chart tell us?
It tells a story of confusion. The stock is just stuck. It's range-bound between about $50 and $66. It's sitting just barely above its 50-day moving average.
So the big money isn't convinced yet.
It suggests institutional buying has been muted. It's a classic case of a strong company that's just waiting for a catalyst, probably strong Q1 2026 results, to prove this is all sustainable.
Clorox's bear case, on the other hand, seems a lot clearer, and it connects right back to that consumer sentiment data we mentioned.
It's a direct hit. The major headwind is the rapid deterioration of consumer confidence.
Right. We saw that confidence index plunge to 65.2. That's the lowest it's been in 12 years.
And a number that low usually means households are about to tighten their budgets big time. It signals deep pessimism.
And that's a problem for Clorox's product mix.
A huge problem. They sell a lot of stuff that's, discretionary adjacent. Premium cleaning supplies, Brita filters. When confidence drops this hard, consumers trade down to store brands fast.
Which just kills their ability to grow organically.
It neutralizes all that hard-won margin improvement.
And the chart. It looks ugly.
It's severely challenged. That 28% drop isn't just market noise. It's a fundamental reassessment. The price is trading way below both the 50-day and 200-day moving averages. It's a textbook bearish setup.
And the volume.
Elevated volume on the down days, we call that distribution. It's a technical signal that institutional money is actively selling, getting out of their positions.
Before we sum up, there's one shared risk for both, right? Tariff uncertainty.
Exactly. This is a big policy risk that could hit both companies.
How so?
Well, if a new administration brings back higher tariffs, both food and household product makers would face a huge margin squeeze from rising costs.
And with consumers so sensitive to price now,
they can't easily pass it on. Tyson's operating leverage gets tested, and Clorox's margin recovery could be erased overnight. It's a risk that could override everything else.
so let's synthesize all of this. The macro shift, the execution, the technicals. What's the final takeaway?
I think the big takeaway is that consumer staples as a pure inflation hedge play, that's yesterday's trade.
It's over. The market has matured, and you have to distinguish between companies that just rode the wave and those that are actually executing.
And when you put them side by side right now, Tyson just offers better risk-adjusted returns. You've got inelastic demand, proven 26% operating income growth, and a reasonable valuation. It's a play on execution, not inflation.
And Clorox.
Clorox is still a fortress balance sheet, and that dividend is attractive for income investors, for sure. But without proof of real organic growth, the stock faces just immense headwinds.
The entry point matters.
Entry points matter a lot, and the current setup with that technical breakdown and institutional selling is just not favorable for capital appreciation right now.
So building on that consumer confidence index, that 65.2 number, I'd like to leave you all with a final thought to mull over.
Okay.
What does it fundamentally mean for this entire defensive sector when weak consumer sentiment becomes a bigger, more damaging headwind than inflation itself?
That's a great question. Are staples now facing this unique double threat? They're losing the inflation tailwind, but they're also facing a consumer who is too worried to buy anything but the absolute cheapest option.
A tough spot to be in.
That dynamic, where pessimism drives this aggressive trade down, that's a challenge that demands really close attention across every corner of the consumer goods market.
See you all in the next Pro Ticker Deep Dive.